The economy has a way of sending quiet signals before the storm arrives. Right now, one of those signals is flashing red. Job growth in the United States has slowed to a crawl, with only about 20 to 30,000 new positions being created each month. At first glance, that might sound like progress, but in a country of more than 330 million people, it's not nearly enough. If this trend continues, unemployment will rise. Families will feel the pressure. Bills won't get easier to pay, and job security will start to feel like a luxury rather than a guarantee. The truth is, we may be standing at the edge of something more troubling, and the time to prepare isn't after it hits, it's now. Before we dive deep into what the Federal Reserve just did, how the markets responded, and what it all means for your wallet and your future, let me remind you to subscribe to this channel. Every week, we break down the financial shifts that impact your life in a way that's clear, practical, and empowering. If you're serious about protecting your money and building lasting security, this is the place for you. So hit that subscribe button and let's get into it. The most recent move from the Federal Reserve has stirred up both curiosity and concern. For the first time since last December, the Fed decided to cut its benchmark interest rate, lowering the range to between 4.0 and 4.25%. It wasn't a drastic change, just a quarter of a percentage point, but the message behind it was powerful. The vote among Fed officials wasn't unanimous either. 11 supported the cut, but one argued for something even bigger, a half-point reduction. Their official statement admitted what many of us are already sensing. Growth has slowed, job gains have cooled, and unemployment is beginning to tick higher. Fed Chair Jerome Powell described the move as a risk management cut, suggesting that the central bank is more worried about the labor market than they've let on in the past. The reactions were swift and divided. Some commentators praised the Fed for finally making a cautious but needed move. Others blasted them for being too slow, claiming that the damage in the job market has already begun. Even within political circles, the decision drew fire. The head of the Minneapolis Fed publicly projected that two more cuts could be on the horizon by the end of the year. Meanwhile, former President Donald Trump had his own sharp words, accusing Powell of being too little, too late, and demanding bigger cuts to ease the burden on mortgages and household debt. He even attempted to shake up the Fed by moving against Governor Lisa Cook, though that effort didn't succeed. What this shows is that the Fed isn't just navigating economic challenges. It's operating under heavy political pressure as well. Markets, as always, were quick to respond. At first, investors weren't sure how to interpret the cut. Stocks dipped, then suddenly surged, pushing several indexes to record highs. The Nasdaq, the S&P 500, the Dow Jones, and even the Russell 2000 all climbed, with the Russell breaking a 4-year dry spell by rising to 0.5%. But here's the thing, traders had already priced in the cut with a 95% probability. In other words, Wall Street wasn't surprised, it was prepared. And they're also betting onto more cuts in October and December. Cheaper borrowing means businesses can access capital more easily, and that sense of relief has fueled a boost in stock prices. But as history has shown, strong markets can sometimes mask underlying weakness. That weakness is showing up in the job market. August brought a sobering reminder when only 22,000 jobs were added nationwide, far below what economists had expected. The unemployment rate climbed to 4.3%. Yes, compared to past decades, that's still relatively low. But the trend is what matters, and it's pointing in the wrong direction. More than a quarter of unemployed workers have been out of work for over 6 months, a worrying sign that opportunities are drying up. Industries like manufacturing, construction, and even tech, once considered unstoppable, are now shedding positions. Over the past 3 months, average job growth has been just 29,000 compared to 122,000 over the last year. This is the weakest pace of job creation we've seen in years, and it's everyday people who are getting hurt the most. Younger workers, those without advanced degrees, and those in lower-skilled jobs are bearing the brunt of the slowdown. So, what comes next? The Fed's projections, often called the dot plot, signal that policymakers are expecting more cuts before the year closes. This marks a shift from their earlier position of holding steady to one of actively easing. Powell insists they're taking a data-driven approach, balancing stubborn inflation with the need to support jobs. In the short term, the stock market looks vibrant, notching a record 27 highs in 2024 alone. But if history teaches us anything, it's that Wall Street's performance can be a smokescreen. Markets can roar even as ordinary workers struggle, and when the reality finally sets in, the correction can be painful. The ripple effects extend beyond stock tickers and bond charts. Rising bond yields are already pushing mortgage rates and borrowing costs higher. Families looking to buy homes are seeing affordability slip further out of reach. Auto loans, credit cards, and business loans are all being impacted as well. The Fed's cuts are, in part, an attempt to counterbalance these pressures, but the tug-of-war between rates, inflation, and job security is far from settled. And this is where the conversation turns personal. Because while central banks and politicians argue about policy, what matters most is how you and your family prepare. There are concrete steps you can take today to shield yourself from uncertainty. First, stay diversified. Don't chase hype or pour all your money into what seems hot right now. Keep a balanced approach, one that can weather volatility. Hold some cash on the sidelines. Think of it as both defense and offense flexibility that allows you to adapt quickly. Second, invest in yourself. Update your skills, especially in areas where the job market is growing. Fields like artificial intelligence, digital tools, and specialized certifications. Keep your resume sharp, your network active, and your mindset open. Those who continue to learn and adapt will be in the best position, no matter what the economy throws their way. Third, fortify your safety net. Build or strengthen your emergency fund to cover 3 to 6 months of living expenses. It may not sound exciting, but it's one of the most powerful forms of protection. If job losses rise, that cushion could be the difference between stability and crisis. Along with that, pay down high-interest debt. The less you owe, the more freedom you have. Finally, think about building multiple income streams. Whether through side businesses, freelance work, or passive investments, having more than one source of income gives you resilience. In uncertain times, relying on a single paycheck can be risky. Security comes from options, and options come from preparation. At the end of the day, the Fed's rate cut is not just a technical adjustment buried in financial reports. It's a warning signal. It tells us that beneath the record highs of the stock market, cracks are forming in the foundation of the labor market. Inflation may still be a challenge, but what's keeping policymakers awake at night is the growing risk that too many Americans could find themselves out of work. And that's why this moment matters for you. Because if unemployment keeps inching upward, it won't be numbers on a chart, it will be households, families, and communities feeling the strain. The time to prepare is not when the storm is overhead, but while the sky is still clearing. So take care of yourself and your finances. Build that cushion. Pay down what you owe. Keep learning, keep adapting, and keep finding ways to protect your future. Remember, stability tomorrow depends on the choices you make today. If this video gave you clarity, don't forget to subscribe to the channel. We're here every week, breaking down the trends that impact your money and your life so you can face the future not with fear, but with confidence.